Thank you for joining us, Indianapolis. This is Wealth in the Winner's Circle with Harley Shanklin, Dave Williams of RDW Financial Group. I'm your host, Spike Spangle. Gentlemen, how's it going this week?
Awesome. Great as always, Spike.
All right. Did you guys see the markets, though, over the last few weeks and kind of towards the beginning of the year? Were they doing okay?
It's just springtime in the world. We get these ups and downs. It's kind of like the weather.
Yeah. We saw it. I don't know that we wanted to see it, but we saw it.
Yeah.
I had no gray hair before the beginning of this.
Before the beginning, you started 2025 with dark hair.
And I had hair.
And Harley had hair.
Nice. Well, but for our viewers out there, we are empathetic. We do understand these markets have been crazy. They've been very volatile. But I will be honest, though, there are good sides to volatility and downsides to volatility. Upside volatility, everybody likes. That's the rising of the markets. But they have been so up and down and up and down. We've got to have perspective, though, for those who are preparing for retirement. And that's a totally different race, if you will. That's a totally different ball game. Let's start with what you guys consider, I've heard you say the phrase, the retirement red zone. What does that mean to you, Harley?
So the retirement red zone, Spike, is that point in time that we get to when we're 3 to 5 years out from retirement. So for those out there watching, the retirement red zone starts the minute you can start to see the start line to your retirement. And that's that 3 to 5 year window before and the 3 to 5 year window after you retire, where we are most at risk to market volatility, the market going down, or at least the negative side of market volatility, because there is the positive side where it likes to go up, and we all love that.
Right. For our retirement planning audience, we probably don't have a lot of 20-year-olds watching this show, but for the 20 and 30-year-olds, this can be a positive thing. The dollar cost averaging is that as you continue to put in every couple of weeks from your paycheck, you're getting the market on sale, right? That's a good thing.
That's a very good thing, because the reality is you're going to buy more when it's down than you will when it's up. But over a 30, 40-year period, that works to your favor.
Yeah.
So don't, when volatility strikes and you're 20 or 30, put more money into it. Keep going, because it will grow over a period of time.
But as we come back to preparing for retirement, a few years away from it, when we see these kind of drops, we don't know if we have the same kind of recovery time. And here's the thing, we were talking about this before, Dave, is that all of us, for the most part, have to choose the funds inside our 401ks, 403bs, 457s, TSBs on our own.
Right.
And you might not realize how much risk we're taking. When folks walk into your office and say, this is what I've been saving in for 20 or 30 years, do they even realize what they're in?
Most people don't. They're going on the guidelines of whatever they read in the manual that was given to them. A lot of people don't even know the difference between an equity and a bond fund. I mean, it's that disastrous or that simple, but that's where we come into play. We have to help them decipher or understand what is that risk they have. I mean, where are they really at? And more importantly, okay, the goal line is in sight, okay? And you've got this linebacker coming at you. It may not be the time to try to hurdle him. Maybe we need to position it so if he hits you, you're not going to go down real bad. You'll be a little banged, but you're going to survive and still be able to get to the goal line on the next play. So that's what we have to look at. I mean, it's positioning that risk, educating the client as to what it is they have, and most importantly, and this is where our START plan comes in, what are they going to need for the next 5 years after they start retirement? Because that's going to be key as to how we take that bowl of 401k and money they have and make it work.
Well, and that's another perspective right there alone, is getting to the retirement, finish line of working and starting your beginning line of retirement. Is it completely taking your foot off the pedal of any sort of gains on your investments? Is that how we protect the risk, Harley?
Absolutely not. Absolutely not. We definitely don't want to go into that red zone with the pedal to the metal. We want to try and ease off a little bit, but we still want you to keep your foot on the gas, because your race is actually just starting. You're finishing one phase of it and now transitioning into the next by starting retirement. And while we don't want to go into it just with the pedal to the metal, throwing caution to the wind, we do want to take that cautious tactical approach to it, where we're still getting some growth in it, but we're pulling the reins back enough to where you're not going to lose everything out there, right? That's not what we want to see you do or happen when you go into retirement.
When it comes to the kinds of gains that you're looking at on your portfolios, sounds like it's a little bit different from your working years to those retirement years. But again, it's not totally pulling back, taking your foot off the pedal, off the throttle, whatever you want to. What are, in your opinion, I understand you've identified 3 kind of different stages of either accumulation and investing. What are those stages?
Sure. So the accumulation phase is in those working years. When you're still out there working, contributing to your 401k, you are in your accumulation years. When you get into retirement, when you cross that line into that phase of life, we then go into the de-accumulation phase. But what most folks don't realize is there's something that happens in between there, and that's the preservation phase. That's where it's not about how much you make, it's about how much you keep. And that's when you're in that retirement red zone, that 3 to 5 years before retirement and the 3 to 5 years once you've gone into retirement.
Dave, in your years of experience, I'm very curious. Do people come in with what they've saved that year or so that they want to retire, maybe 6 months before, and go, how did I do? Or are you getting people a few years ahead of time where you might be able to make some corrections? What kind of age frame are you getting for folks who reach out to you?
So we're seeing a definite shift in it for the good. I will tell you, 15, 20 years ago, we would have people that come in and say, so I signed the papers and I'm walking out next week. What do I do? Today, people, I think, are starting to realize there's been enough public information put out there, enough educational events that people know, look, I'm 50, I'm 55, I really need to get started on this. Ideally, we like to see them in their 40s or even earlier because we can set a plan, okay? But if you're at 50 years old today and you do not have a START plan or a retirement roadmap or know what you're going to be going through over the next 10 to 15 years, you're putting you and your family at a pretty big deficit.
Bam. All right, Harley, tell our viewers out there right now where you can do a risk review, a 401k review if you're still working, and a can you be and stay retired review if you've already stepped into retirement. You'll do that for the viewers who reach out?
Exactly. For everyone out there watching right now, that's one of the first things that we want to help you do is to analyze the risks that you have in your portfolio, whether that's in your 401k or your IRA, and make sure that you understand the risks that you're taking, that you understand what your risk tolerance is, which is your emotional response to the ups and downs of the market, as well as your risk capacity. And that becomes all the more important. Risk capacity is something that not many folks have heard about. And that really speaks to how much risk can you afford to take. And when we're in that retirement red zone spike, we can't afford to take that much risk.
Right. If that's you, if you're in that retirement red zone, if you're seeing the finish line, hopefully, of your working career coming up in the window, then you need to call that phone number. Let us do that risk review. Let us put together your complete financial plan, and it's so simple. Call the phone number right now. There are folks standing by who will schedule that appointment for you. Or if you want to do it on your phone, open up your phone to the camera function, point it at this QR code, and click on it. It'll take you over to their landing page. You can schedule your own appointment right there. We're going to talk about the investment strategies of the RDW Financial Group when we get back right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to Wealth in the Winner's Circle with Harley Shanklin and Dave Williams of RDW Financial Group right here in the Indianapolis area. If you're seeing us on the airwaves, they'd be glad to put together your free written financial plan. The investment management is really important. Can we talk a little bit about allocation? I don't want to get too deep in the weeds because obviously it's got to be different literally for every viewer out there. But where do you guys kind of start maybe as a baseline? What's your identity?
Well, the allocation is going to be driven by the needs of the client. In other words, we have to go look at the income needs and how to structure a portfolio that provides for inflation adjustments, risk adjustments. And so when we look at allocation, a lot of people hear that word and think it's just stocks or it's just mutual funds. In fact, it's taking the various different asset classes, putting them together to work together. It's kind of like having a race car, making sure you have the proper tires, the engine's tuned properly, the brakes are working, and you have the right fuel in it to get it from A to B. And it's the same thing with portfolio allocation. I can get into the weeds and we can talk about correlation where, this asset should operate in the opposite of this asset. And unfortunately, Spike, be honest with you, we bring a lot of people in and we see their portfolios, they're correlated, like they might have what they call a 0.96 correlation, where if asset one goes up, asset two is going to go up. And when asset one goes down, asset two is going to go down. And they can't understand why they're not going anywhere. They're just churning and churning and churning. So they're the components we will start with to bring it together.
I'm so glad you brought it up because we did open the show with the market volatility of this year, but you shouldn't have, hopefully, as much market volatility, again, that retirement red zone, if the things that you are investing in, I'm simplifying it for people like me, to go, it shouldn't be correlated. So when there is a severe drop, hopefully you have a couple other things over here that might go up. Making sure, and how many times, Harley, do you see that people think that they're actually diversified, and they're really just in different titles of funds with different platforms?
All the time, Spike, all the time, because unfortunately, most of the investments out there are highly correlated, right? A lot of mutual funds, mutual fund A, mutual fund B, are invested in the same exact companies out there. And so oftentimes, as Dave just said, when we see opposite or one go up, we see two go up. When we see one go down, two goes down. That's just not what we want to see. We want to make sure that we've got true diversification within a retirement portfolio, and that's where it comes down to having a plan where the investments are structured to support everything else in your retirement, from income to taxes to healthcare, everything that's involved in there.
How much do you really go into this, and how much do people really ask you and say, show me the mechanics of it? I always like to say that I don't want to know exactly how the watch works. I don't need to know where the gears go. Just tell me what time it is. Some people probably want to know, how is this going to work, Dave? Some people are just going to say, I just want to know if it's going to last for me. Do you go into these deep Wall Street terms with folks, or do we simplify?
For the accountants and the engineers, we dive deeply into those subjects.
They love spreadsheets.
They love spread. And, I think it's important. I mean, my dad was an engineer. My brother's an engineer. I enjoy explaining the mechanics to them. And we do some unique things that other people in the industry don't do in terms of asset allocation and active tactical management. For the people that aren't into that, we just want to show them how it works in conjunction with their portfolio, how it will benefit them, and why it's important. And if they understand that and we can teach them that, then they'll be able to sleep at night, and we will have done our job.
I think that's probably one of the biggest concerns. Different financial advisor magazines have all said the number one concern for retirees isn't death itself, but it's the running out of money.
Yeah.
And wondering what to do next. So stretching out the portfolio, using the assets that people have saved and created, and then coming up with a return. Again, though, Harley, going back to you, it's not necessarily swinging for the fences. I mean, because if somebody comes in and says, hey, tell me about the returns of your portfolios, you say, well, the folks who come to us, they've got a different objective. We're not necessarily looking for grand slams. We're not looking for 250 miles an hour all the way around the track. We just want to make sure we don't crash the car.
Exactly. If someone out there is looking for a home run, we're probably not the right firm, right? That's just not what we do, Spike. We like to tailor it to you and to ensure that your retirement is going to last. It's just like in a car race, whether it's an Indy car race or a NASCAR race. every driver doesn't just have their pedal to the metal the entire time. We have to be able to conserve fuel so we can finish that race and finish it strong. And it's the same thing when it comes to your retirement. We don't just want to be all risk in, all in the market. We want to pull that back. And when it comes to clients asking about returns, what our portfolios look like, we can talk about that, but that's missing the more important question, which is, what return do you need? What return do you need out there to ensure that your retirement lasts as long as you're going to last?
Right. Like we've said before, it's not crashing the car on that final turn. Why step on the gas when you've already got the retirement race run? Now, you want to make sure that that money's going to last. You've got to put in lots of different kind of factors. But before we go out to the break there, can you just explain what you mean to be by tactical? I think everybody out there has heard that phrase, buy and hold.
Tactical is basically being an actively managed account where it's dynamic. So one of the expressions I've had with my clients all along is like, I'm not so much interested in doubling your money as I am making sure you don't lose half of your money. Tactical for us is very simple this. We are constantly analyzing market conditions and investments to absolutely take care of and also avoid the craziness of the world, if you will. We were very effective during the pandemic, through 9/11, through the housing crisis. We focus on a unique set of stocks, if you will, going back over 60 years of history, where we focus on the dividends, if you will, and also the cash returns and how the company is doing from a cash flow standpoint, because as we say, dividends don't lie. So we're always looking to measure risk in the market, see what's going on, and in the current volatility, making sure that when things get really bad, it's like, okay, time to take the cards off the table, let this play out. It's okay to get, X% in the money market fund. There will be a time for reentry. We're never going to hit the exact bottom or exact top. If I tell you we're going to do that, then that's the first lie of anybody's ever going to tell you. But we're really concerned in making sure that when those market days come, we're out. And if it's a continued trend, why take the risk with somebody's retirement?
Harley, we're going to go out to break here, but maybe you can explain to folks what a portfolio risk review is. So if somebody reaches out to us, calls the phone number, they come in and say, hey, bring in your statements, we'll give you a second opinion, we'll take a look at it. What goes into that?
What goes into that, Spike, is just simply a series of basic questions that we'll walk through with you, explain it along the way so we can understand how you feel about the movements of the market, as well as look at all of the assets that you currently have to see, does the current investment structures that you have match up with both that risk tolerance that you have and your risk capacity to ensure that it's all in alignment? And if not, show you how to correct it.
That phone call is no cost to you, that meeting is no cost to you, and that risk report is absolutely no cost to you. Call the phone number right now down on the bottom of the screen. Let's do your portfolio risk review. If today's ups and downs of the markets are keeping you up at night, as Dave says, let's put you back to sleep. But unfortunately, your portfolio can't stay asleep. We've got to make sure we've got enough returns to keep you going through your retirement years. Call that phone number, set up your appointment, don't go anywhere. More solutions to today's market volatility when we get back right after this.
Good morning, Ben.
Good morning, Ben. Hey, birthday party for Carol and 5. Happy birthday to you.
Good morning, Ben. Happy Monday.
Daryl's birthday, be there every square. Happy birthday to you. As you can see from our quarterly report on slide number 62, we're trending in the right direction. All signs point to a very positive outlook for the next several years. If you peel back the onion...
Ben, do you have anything to add?
The work never seems to end until the day it finally does. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back to Wealth in the Winner's Circle with Harley Shanklin and Dave Williams of RDW Financial Group. Yes, the show's name is a little bit of play on the Indianapolis area. Wealth in the Winner's Circle. We want to make sure that you can be and stay retired, work with the assets that you've already accumulated, and not crash that car in the final turn, trying to take risks that you really shouldn't. We're talking about the portfolio management. There was a word that I saw on your website that was really stuck out to me: rebalancing. I get it as a concept. Maybe you can explain it to the viewers. What does rebalancing mean for a tactical portfolio?
Sure. So rebalancing really just speaks to how we have our money allocated from our viewpoint as to when we're going to need it, when you're going to need it in retirement. That's important for most folks going into retirement. Maybe you sitting there right now, all of your assets are sitting within that 401k or within that IRA. And one thing that we help all of our clients do is look at to see how do we rebalance into potentially other investment vehicles that are outside of the stock market and may not be impacted, whether it's cash, annuities, CDs, anything like that, to help provide some sort of protection, right, to where we're not taking our foot completely off of the gas, but we're still moving forwards.
I would imagine, just like anybody, you've got those pie charts, and you've got different slivers of those pie charts and all different kinds of assets. And the rebalancing is that some sectors are going to grow, some are going to shrink, and now you got a pie chart that's out of balance. So you're not necessarily trying to guess the markets and see what's happening. You're reacting to what's happened. How frequently do you look at something like rebalancing?
So as a general rule, unless there's a major world event going on, we're looking at it twice a month. I'm looking for
Really?
Yeah,
Wow.
I'm looking at economic conditions twice a month. Not to make wholesale changes, but to keep, if you will, my pulse on the engine. How's it running? You know, I can't close my blinders off and say, oh,
Yeah.
it's fine, just let it go. But so I'm constantly listening. Major rebalances we usually target for twice a month. We're not traders. We're investors. Investors means long-term plan going through. As you've seen, and we've all seen of the recent times, volatility can raise its ugly head real quick. So we want to be in tune to that. And we also want to make sure that as conditions change and as we meet with our clients, if something's happening in life, rebalancing is not just moving in and out of sectors, it's taking the assets and moving it from one type to another to fit the client's needs.
And I think an important thing to add on to what you're saying, Dave, is the importance of proactive rebalancing. We don't necessarily want it to be reactive. Sure, that's going to happen at times, but we want to be proactive about it to make sure that as we're going into retirement, that we've proactively rebalance all of your assets that you have out there to ensure that as you're running that race, any rebalancing that we need to do are just those small little tweaks, but we want to do it in a proactive way. We want to have control over that as opposed to just reacting all the time to what's going on out there.
Those who fail to study their history are doomed to repeat it. If we go back to some of the crashes of like 2008 and 2000, the reason I'm bringing this up for you, Dave, is that there were folks who chose their retirement accounts, the funds in there, and never probably had this word rebalancing. Now, a lot of 401ks have a box you can check in there. Yes, we agree with rebalancing, but that might happen once a year or quarterly. I think with you doing it, looking at it at least a couple of times a month, does this help kind of preserve that safety issue for people into retirement?
Yeah, we call it peace of mind management, all right? Very simply, and as Harley so eloquently said, I don't want to be reactive, I want to be proactive. Doing what I've just learned over my lifetime and over my career is that keeping an eye on the ball, keeping an eye on the engine at those periods of times really helps keep us focused. It allows Harley and I to communicate to our clients. We're really big on letting our clients know monthly what's going on in the portfolios, what are we thinking, and what are we doing? I mean, we've just to believe that communication is the key to a successful client. And again, I go back to this, but it gives them that sleep in their portfolio.
Can I ask you this about RDW Financial Group?
Sure.
Is everything about investment strategy, or are there some tools that maybe we can protect even from the ups and downs of the market with a little bit of growth? I mean, we've got to start taking this money out for income.
Yep.
Is everything 100% market-based?
Absolutely not. Absolutely not, Spike. You know, when it comes to various asset classes out there, we tend to all think at and focus on the stock market, whether that's stocks, bonds, or mutual funds, ETFs, all these things. And we want to take a different approach to that. We want to make sure that not everything is subject to the whims of the market. And unfortunately, how most of us Americans out there buy bonds is through bond funds. And unfortunately, those bond funds are traded on the same stock market that all of your stocks are traded on. And so we can see those go up and down. So we want to look at other asset classes that you may have heard of, things like index annuities, income annuities, to help guarantee income while allowing for growth, but with zero downside risk to it, where we don't have to worry about if the market crashes that we're going to lose half of our money there.
Spike, it kind of goes back to our thought of being an independent firm, okay? Harley and I don't think there's any bad products, well, overall bad products. There's bad implementation. They're misplaced products. You know, when you go out and make a blanket statement about a product and say, I don't like them and I will never sell them, you're really just shortchanging your client the opportunity to maybe take advantage that it's appropriate for them. And so that's why we do look at alternative investments. We do believe in them because, again, as I started from the beginning, I said about my company, there isn't one product or one company that I believe solves everybody's needs. So we are real versed in using all of those.
And I think that's the bigger picture maybe for our viewers to think about, is that we always hear this phrase, especially at live events, I've got a guy, I've got a person who does that, I've got somebody who helps me with my financial management, I've been with them for 20 years. But if they really are only talking to you about one kind of tool or set of solutions, they might not be that independent, full firm that has all of the offerings in there, trying to kind of almost keep your own opinions out. They're just a tool. It's not something to feel good or bad about. It's more about implementation.
Exactly, exactly.
There's bad engines, good engines, and bad tires.
Yeah. Well, and there's certain engines you can't put into certain type of vehicles.
Exactly.
Yeah. Hey, my one last cue question. I remembered this. So in the scheme of the retirement planning for the portfolio, with all of it, are you more of the driver in the car, or are you the pit boss?
Pit boss.
You guys are in charge of all of it.
Yep.
Keeping our eye on it. Very quickly, there's 5 elements in the S.T.A.R.T program and in the S.T.A.R.T review. What exactly are those?
Secure income, that's Social Security, pensions, annuity income, tax efficiency, making sure you're not paying too much, advanced planning, where we look at estate planning, risk management, risk to your life, health, and investments, and then it finishes up with that tailored investment strategy.
Harley and Dave, thank you so much. Today's market volatility, I know, is probably making you a little bit nervous. Start your retirement planning right now. Get the 5 elements of your portfolio review started right now. Call that phone number. There are folks standing by. They'll schedule that appointment. You can come in and sit down with the team. It is no cost to you. Thank you so much for watching. We'll be back next week.